We're going to talk to Stephen Roach, who is Morgan Stanley's Asia chairman, and he joins us this morning from Beijing. Stephen, here we go once again. It seems like deja vu of 2007, doesn't it? Why do American lawmakers continuously try to preach and to basically make another country move on its own domestic policies?
Because, Susan, they don't want to look in the mirror. America doesn't have a China problem. It really has a savings problem. America has the biggest shortfall of national savings of any leading country in modern history. And when you don't have saving, you have to run current account deficits to import surplus savings from abroad and run massive trade deficits to attract the capital. Last year, America ran trade deficits with over 90, that's right, 90 countries. China was the largest piece because U.S. multinationals do conscious outsourcing to China for cost reasons, and American consumers have preferences for low-cost, high-quality goods produced in China. If we want to fix the China problem, quote unquote, we got to get our own act together and deal with a budget deficit and boost national saving. There's no way around it, and Congress does not want to face up to that.
Now, Stephen, of course, there are really strong words coming out this week, even from economists such as Paul Krugman, who's a Nobel laureate, saying that if China's not going to move with sweet words, you take out the baseball bat and basically you threaten them with tariffs and you levy them if need be. What do you think of that sort of response?
I think we should take out the baseball bat on Paul Krugman. I mean, I think that the advice is completely wrong. You know, the U.S. has had a conscious policy here of maintaining, quote, a strong and stable dollar. China is saying basically the same thing in terms of its stable currency. Isn't it at the height of hypocrisy that America can articulate a particular position in its currency, but the Chinese are not allowed to do that, especially since they, as a developing economy with an embryonic financial system, need a currency anchor probably a lot more than more sophisticated, quote-unquote, economies like the United States.
Okay, one more for you before I'm going to pass it over to my colleague Paul Gordon, Stephen. But let me just ask you about what Senator Schumer had to say in his thoughts on what China's currency regime has meant for the global system. He said it's basically been one of the causes of the financial crisis. Is he way off here?
Look, Senator Schumer has been bashing China now for about 5 years. I think he's probably been to China once during that period. And he always has the view, no matter where the renminbi is, that it's 27.5% undervalued. Senator Schumer is very focused on jobs, understandably so. But the question that must be posed to him is he convinced? What is the evidence that a higher renminbi is going to make life easier for American workers who are suffering relatively stagnant real wages and an unemployment rate of nearly 10%. It's ludicrous to blame China for the financial crisis. This is the fault of America's central bank, which ran a very, very accommodative monetary policy that Schumer has had very little criticism to direct to.
Stephen, it's Paul Gordon here. I want to focus on that U.S. issue just one moment, because I got a chart, a very, very simple chart, but it tells a very big story. We know how China's been growing much faster than the U.S. for a long time, but because the U.S. is so much bigger, the dollar gap between U.S. and Chinese GDP was always widening. That ended in 2007 and narrowed again in 2008. I mean, this basically tells me we've reached the end of an era, unless the U.S. does something magical to turn this around, yes? Well, look, there's no question, Paul, that China is on the ascendancy, and America it's questionable as to whether or not America will maintain the position it has for the last 75 years. The scale differential between the two economies is still enormous. I mean, America is still nearly 3 times the size of China on a nominal GDP basis. But the bottom line of what you're saying is that Washington is uneasy with this this cross current of trends where there are problems in America and China seems to be plowing ahead in a way that we've never seen from a developing country. And so we're lashing out at China rather than tending to our own business of boosting our savings rate
and figuring out how to get better rewards to a broader cross-section of American workers. This is not China's fault. This is America's fault.